So your business has made money. Now what? How does that money go from the company checking account to yours? Join us as we break down every option: salary, owner draws, dividends, distributions, and guaranteed payments, explaining what each means and when it makes sense so you can pay yourself with confidence.
Your creative genius deserves the same precision behind the numbers.
Welcome to Let's Get Fiscal,
Hosted by Anastasia, Myiesha, and Danielle.
Part of the women-led team at Coterie Tax.
from smart tax moves to cash flow strategy.
We decode everything it takes to run a thriving, creative business
So you can scale with confidence and sleep easy at night.
Press play.
and let's grow your business.
Hi, welcome to the Let's Get Fiscal podcast. I'm Myiesha and this is Anastasia. And what are we talking about today?
Today, I wanted to go over some of the ways that you can take money out of your business. So it's one of the big questions that I get is, I made money, but can I keep it? Or
Yeah.
how does it go from my business to me in the proper way?
Okay, cool. So I guess I'll start with why does this matter? Like how you pay or move funds.
So there are situations where maybe you have a C corporation, you maybe you pay yourself too much.
Okay.
And the IRS can come back and say, hey, that's not a reasonable salary. This is actually dividends. They can reclassify that payroll that you've already paid Social Security and Medicare on as
fun.
dividends. And then that gets added to your tax return. So then you have to pay income tax on that because there's double taxation. And then you have to pay late fees because you didn't pay it when you originally filed your return.
Oh, they get you on all the angles.
You also get an additional fee because you understated your income by more than 20%.
Okay, so that's at least 4 penalties? At least? Okay.
Exactly. And the ongoing interest from whenever they found it. So if they can go back 3 years, they choose 3 years ago, that's a significant amount of interest, especially if they're at, 7 to 11%. And
Yeah. Okay. So you need to do it correctly.
Right. Because if you don't do it correctly, the IRS can still go back and change it for you.
Gotcha. Okay, cool. Yeah. So I guess dive into it. What are the different ways that we can do this?
So really, the ways that you pay yourself depends on how the company is formed.
Okay.
So that's really what we're looking at. And that's why some people will get a little bit confused because sometimes the words are used in weird ways or interchangeably. But really, it all focuses on what type of business do you have.
Okay, cool.
So I'll start off with, in the initial phases, you either have a sole proprietorship or a single member LLC. So those companies really are just you at the end of the day. So when you are earning money, that bank account, a sole proprietor may not even be using a business bank account, even though it is possible.
Yeah.
You can get a business bank account under your social. But you can really just transfer whatever money you want out of that because as you earn the income, it's going to be taxed when you file your tax return.
Gotcha.
So it doesn't matter if you take the money out or you leave the money in.
You're going to
still
get
gonna
taxed.
be taxed.
Okay.
And so those are called owner draws.
Okay.
So
that's one. What are the other guys? There's more types, right?
Yep. So also at kind of that level, we have the multi-member LLCs or partnership.
Okay.
So that's when there's more than one person involved. And those do file their own tax returns. And there's a couple different ways because, again, you have that kind of partner draw that similar to the single member LLC where you can just take some of the profit and distribute it to each of you.
Okay.
But there's also an additional level called a guaranteed payment. So there are some situations in a partnership where each partner is going to be treated differently based on what they're doing. So, for example, maybe you have one partner puts up all the investment money, but they don't actively participate in the business.
Yeah.
And then you have one person that's running all of the day-to-day stuff. And the person that gave the investment says, hey, because you're doing all of this work, I'm going to pay you a regular salary, just like we will are other employees. And that is what's a guaranteed payment.
Okay.
So it identifies the income that's very specifically for that one partner because of the work that they're doing in the partnership. And then the other partner isn't having to pay tax on it. And they're only paying tax on the remaining amount that's being distributed. So you have the partner distributions, which is a distribution of the profit. And then you also have guaranteed payments, which is kind of like a salary for one of the partners, because the partners can't really be a W-2 employee of their own company.
That's fair.
So that's, that's kind of how you're able to separate on a partnership level what belongs to each person based on what they're doing outside of the profit share that they get.
Okay, so then what about an S Corp?
So an S corporation is where we start to get a little bit of the muddling of terms because it does take on a lot of the characteristics of a C corporation. But in an S corporation, you really have the two types, similar to the partnership, but we're going to call the first one is going to be the reasonable compensation, which is an actual W-2. So they will receive a W-2 from the company. And then the second part is going to be distributions. So with reasonable compensation, that needs to be based on the services that you actually provide the company. And again, that's another reason why you need to be very careful that you're choosing a reasonable compensation for yourself, that you're able to back up and show how you are able to come to those numbers based on, you know, the market rate for the services that you're providing in your area. Because this is a great scenario where if you take too much in distributions, the IRS will go backwards and say, hey, some of these distributions are actually payroll. So now you owe extra payroll taxes.
Gotcha. Okay. Is it helpful to have this backup for if the IRS ever questioned anything of this? So like having that backup to provide them so maybe there wouldn't be as many, or like they'll be like, okay, I see where you were going with this. Yeah.
Definitely. So if you're going to determine it on your own, I normally say have at least 3 different sources to be able to show that it is market rate in your area and that you are doing reasonable increases annually. Because you should be considering, if you hired a person, would you give them a raise year over year?
Like really train yourself like an employee.
Exactly. And there are some services that will even provide addendums to the corporate minutes showing what you as an officer should be earning. So you have a lot of documentation there on how you're getting to those numbers, and that other people are proving that that is going to be a reasonable salary for you.
Cool.
And they're also looking at if you have other employees, how much are they making too? So, you know, if you're the actively working in the business and you're the one that everybody's going to, but you're getting paid the lowest salary,
there's like a question there.
That's going to be a question. So once the reasonable compensation has been taken care of, every dollar after that gets to be a distribution. And that's really similar to the single member LLC, where because this is a pass-through entity, at the end of the day, it's really just you. So there is a lot of easier movement of funds in and out of the company. So it's not unusual for, especially a seasonal business, let's say in the beginning of the year, maybe they take a larger distribution. You can put it into a high yield savings account. And then later in the year, when it's kind of the off season, you can put that money back into the company as an investment.
Cool.
And just like easily move money in and out through those methods.
Nice. Okay. And then I think it's the last business type, C Corps.
Yep. So C corporations, they're going to have this same requirement for reasonable compensation. So whatever you're doing to create your compensation under the S corporation, you can do similarly under the C corporation. It's just once you've hit your reasonable compensation, every dollar after that is a dividend.
Instead of a distribution.
Correct. So on the corporate level, all of the profit is going to be taxed at 21% on the federal level, and then depending on the state. And then when you withdraw a dividend from the company, you will also be charged on your personal return.
Oh, okay. All right. So you want to be careful a little bit of that, like making sure you're aware of like how much you've taken and all that throughout the year.
Right.
Okay.
And then keeping track of how long have you owned this stock, because if you've owned it for 1 year and 1 day, then you can qualify it as, it's qualified dividends versus a normal dividend. So there are some advantageous tax rates there where it's a little bit lower than regular earned income would be taxed at. And then also on the C level, there is a penalty if you don't distribute funds.
Oh, okay. All right.
They are tracking to make sure it's kind of like the traditional IRA where they're like, okay, I know you could keep this money in the C corporation forever and not have to pay that dividend tax on top of the tax that we've already charged you for the company. But if you don't have a specific use for these extra funds, then we're going to charge you a penalty for not distributing it out to the shareholders.
So basically like forcing your hand to like distribute that. Okay.
So that's where I see some of the different confusion between an S corporation and a C corporation because they'll try to mix them up sometimes. Because they both have that like corporate structure. But in an S corporation, it is called a distribution. And there's no additional tax when you take it out. Because again, like the single member LLC, you're taxed on the income as you earn it, whether or not you withdraw it. With the C corporation, you're going to be taxed on the profit, but you won't be taxed on those dividends until you take them out.
Gotcha. Yeah.
So
okay. I mean, they both start with the letter D too. I can see that getting a little a little funky.
Yep. So with the C corporation, that's going to be the most restrictive structure to take money out, because you have to think this is a completely different entity. So I tell people, think of it as your cousin. Yeah. You can't just walk up to your cousin and take money out of their bank account. There's a couple steps in between there, versus the S corporation or the single member LLC, where really it's you at its heart. So it's easier for you to take money out of your own bank account. Okay. But the C corporation, it does need to be reported in special ways and things like that.
Nope, that makes sense. So outside of like running payroll, doing distributions and dividends and whatnot, is there other ways that you can move wealth from the business to yourself?
Yep. So a lot of these are just kind of high level items. But what I also like to look at is what are things that are improving your quality of life, or other ways, like you said, that we can transfer the funds into your personal portfolio without incurring additional taxes or in a tax advantaged way. So one of like the low hanging fruit would be retirement.
Okay. Yeah. Oh, that makes sense.
If you put money into a SEP IRA, you get the deduction for 25% of your payroll, but you're not having to pay any additional Social Security or Medicare taxes on it. So it's still kind of money moving from the business into your personal account. Yeah. May not be accessible for a little while, but like I've said, there's certain situations where you don't have to worry about that penalty, and you're building up that nest egg for your retirement later on. And then also the company can adopt an accountable plan. So an accountable plan it really works just like any other employee reimbursement. So if you've worked in a W-2 job where you fill it out, you say, here's the date, here's who I purchased it from, here's the reason.
Oh, like a reimbursement request? Okay.
And then a receipt or some type of proof of payment. So the company adopting an accountable plan and a process by which the company can reimburse the employees for the expenses that they've paid on their personal accounts. So that's another way where you can have some of that money transfer from the company over to you.
Gotcha.
So a lot of that could be, like a home office allotment. Or reimbursing for the use of a cell phone. Or maybe if you were traveling and you put the flights on a certain credit card because you get extra points. Some of those different scenarios. Then you can fill out this accountable plan, have that documentation on file, and then the company is able to reimburse you.
Okay, that's cool. Costs. Yeah. And that's pretty normal and standard if you were like a W-2 employee anyway. Exactly. So just making sure you're treating yourself like that. I got you. Okay, cool.
So there's also a couple of other different ways that you can earn a profit from the company and have it affect your daily life. But that's kind of where the tax strategy comes into play, because we're asking questions about what is your lifestyle? What are your goals? And then based on that, we're able to adjust what the strategy is for the company and adopt programs like an accountable plan, or choose which retirement plan works best for you at the income level that you're at. So outside of reasonable compensation and distributions, there are other methods where you can transfer some of that income from the business over to yourself to improve your quality of life.
Yeah, in a strategic way. Yes.
Right.
I like it. No, that's awesome.
So, I mean, really, before the end of the year, especially if you're a C corporation or an S corporation, you want to make sure that you've paid your reasonable compensation. Because if you don't pay your reasonable compensation and all you take are distributions, that's going to be like one of the first things that the IRS is looking for. They can see that you have a K-1 from an S corporation, so they're looking in box 1 to see if there's a W-2 there. And if there's not, then they're going to automatically, flag you to reclassify some of that to wages.
Nope, that makes sense.
So meeting with a professional, really determining what is a defensible, reasonable compensation instead of paying yourself, just a tiny bit. And also with the reasonable compensation, it's also limited by how much money you take out of the company.
Okay.
So there's other questions that you have to ask yourself when it comes to how are you going to classify these. But otherwise, for the most part, it is a relatively simple way to transfer a distribution over to yourself. You just want to make sure that there's enough money remaining in the account that the company can continue its operations.
No, that makes sense. It also maybe some professional help too, it sounds like, to do it. No, that's amazing. Thank you for explaining it.
So that is a little bit more on the different ways that you can pay yourself and move the profit from your business into your personal checking account. So if you have any questions, put a comment below or like and subscribe. We'll see you next time.
Bye, guys.
That's a wrap on Let's Get Fiscal. Ready to stop guessing and start saving?
Click the link in the show notes.
Grab your consult and let's make your business work for you,
Not the other way around. You've got this.